Mark, are you getting closer to your closing?
Oh, I think so. Yeah, we've got about we've got 3 or 4 questions from the credit team, and pretty simple to answer. So we'll get this in tomorrow, and we'll see what happens from there. Of course, I'll leave it to Alan and tell me if I'm close or not. He knows better than me.
Yeah, that's great. That's great. Yeah, there's always those last minute things that do come up. There's always, in the spirit of crossing T's and dotting I's, right, Alan?
Yes, absolutely. We're just getting a few items in, but we've given the go-ahead internally. It's a matter of just getting the documentation, a couple of key points there. But fundamentally, we're in great shape, and Mark's been awesome to work with, of course.
Yeah, in my old days in banking, when we tried to get to a closing, I always had this mental image of this giant spider web of a decision tree. It's kind of like this if-then logic. If this is true, what do we have to do here? If that's true, what do we have to do there? If it's not true, what else do we need to do? And what other page do we need to turn? And it's inevitable. You can't solve all of those in one pass up front. And I'm not trying to make excuses for my friend Alan, but given everything that does happen in the banking world and the standards he's being held to, you have to kind of give him a little bit of grace and appreciate the need for that to happen. And that's inevitably what it's about. But as we've said before in audiences, finding a banking partner that does that whole process well and make it as painless as possible for you guys, the buyers, that's what we certainly shoot for here at Acquira. And when we talk about the whole body of work, in our humble opinion, Alan and his team kind of rise to the top of the class. So there are some other great lenders out there that we've had opportunity to work with too, but it's also gets down to a little matter of volume. When you see somebody doing it at scale, then you still want to see that kind of response and flexibility. So casting some shade your way, Alan. Congratulations and thanks to your team for the hard work you guys do.
Yeah, no, grateful to work with a lot of great folks. I've had the opportunity to meet some really, really great people through working on deals, and you become friends, you build rapport, and you kind of feel like when it's all done, like two people that have survived a shipwreck or something. Like it's like this. And then here's the good news, and I pull no punches on this. This is the easy part. Now you own a business. Now you have the personal guarantee, dependent upon, are you going to take the advice that was given to you? Are you going to utilize, all of the plans and procedures and stuff? So it's definitely a lot of fun, and I'm super grateful to have the opportunity to work with you guys. So thank you, and thanks for allowing me to participate with you guys. I just feel like the only one without a Bubbles note taker, but that's okay. I got a pretty good memory, so we'll be all right there. I'll use marks if I need to.
That's become a new tradition on this call. We sometimes have more note takers than we do live people, but we welcome people consuming the information however they might be able to get it. But really, without further ado, I want to get this thing started. I have asked Alan to join us. Alan Peterson from First Internet Bank, as I mentioned, is one of our premier referral sources for SBA lending. Again, there are others in the world, but Alan has been a long time supporter of the program at Acquira. He's been good to work with. And the reason I ask Alan back, some of you have been around long enough, you've probably heard him talk on this call before, but we have quite a number of new AEs that have joined our ECO 60 days. Really, quite frankly, I don't know if that's as much a statement about our new sales team and how effective they are in getting things done, or I can't help but believe there's a little bit of new energy and excitement in the market because of things going on in our country in general and the business climate that people are thinking about. And not here to make a political statement one way or the other. I'm just looking at the numbers. And we at Acquira, we've actually added 25 new AEs since January 1st. And that's a giant leap in our somewhat normal throughput. And we're very happy about that. And we're very excited about the people we're meeting, kind of the quality and caliber of folks that are coming to this game. And Alan, as you get to meet more of these people, and I know you will, I think you'll agree with us. We have a whole new brand of folks showing up to pursue this great opportunity that's out there. And I'm not saying that to be mean to anybody else that's been with us a while. It's just because you guys were the leaders at the time. But we've penetrated a whole new level of the market, I think, and really excited about what is to come. You know, every new AE we get that is a smart, quality individual. You never can have too many quality people in your personal network. That's what I've said for a long time. And I think this is a great example of it. And we've got a lot of that going on for us right now. But with all of that said, Alan, I'd like to hand it over to you if you've just got some general opening comments or things you want to share with us.
Yeah, absolutely. Thank you so much, Doug. And thank you all on the call for allowing me to participate and kind of, I always feel like I'm taking a meeting hostage, right? You guys have your normal order of business and I pop in, and I don't mean to disrupt the flow here, but I'm certainly grateful to be here. For anyone that I haven't had the opportunity to connect with, my name is Alan Peterson. I'm a national SBA lender focused on business acquisitions in all 50 states. I'm located here in my home office, including my treadmill I don't use enough and my aquarium that needs to be cleaned, live from Tampa, Florida. I'm originally from Northeastern Pennsylvania, been down here for about 6 years, and I'm with First Internet Bank of Indiana. Essentially, what we are is cash flow based lenders. So we're looking for what you're looking for, right? We're looking for, predictable, consistent cash flow on opportunities with opportunity for growth. Some of the alignment that we've experienced so far with the success we've had with many acquired AEs is that, you guys are generally looking for the same that we like, and from a bank perspective, that's always great. As cash flow based lenders, we're not overly reliant on collateral. So, the SBA has their guidelines and collateral requirements, which of course we follow, but we have no issue doing a deal that might be a larger, uncollateralized or unsecured risk. That's one way we lead the market. Another thing that we have the ability to do is provide lines of credit, which is good. So I think that is something that sets us apart, as a lot of banks get hung up on working capital. We try to not be that way, and we try to, make sure we're making good decisions. Surely not extending more money than you need for any reason, but making sure that you're well capitalized, as when things do go sideways, undercapitalization is the number one offender. We look at a variety of industries here. I've closed deals in all sorts of sectors. Year to date, I'm at $20 million closed and funded for the year of 2025 in SBA 7A loans for business acquisitions. That's not to beat my chest, but it's just to let you know that I'm highly focused on execution. I like to be objective, as many that do know me will be able to share firsthand, in that when I review a deal, I want to make sure that we are making a good decision. We all want to close a deal, but it's imperative that we close the right deal. So I consider myself a true partner. I'm not a transactional SBA guy or gal, right? That's not who I am. I'm not going to try to do a bad deal just because the lease payment on my 3 Series is coming up. That's not who I am, and it's not what I'm about. I want to make sure that you buy a business that you can sleep all right owning, and uncovering things with you is super exciting for me. That's essentially kind of who I am. I only offer SBA 7A loans. I love a 5 and 5 structure, meaning a seller note that can count towards equity injection. As you may or may not know, as long as the seller note is either on standby for 2 years, meaning no payment is due, or interest only payments are for the first 24 months, and there's no balloon due at the conclusion of the term, that will count towards your equity injection. Another thing that we do is that we're going to apply any and all acquirer-related fees towards your down payment or your equity injection. We see significant value in the partnership. For that reason, we think that it is a true direct deal-related expense. Thus, by the letter of the SBA law, it does qualify. So, proof of payments and invoices are as good as cash when we're looking to calculate our final closing, statements. And I can get further into that if people do have questions, but those are some key items here. Hi, Luther, how are you?
Hey, man, what's up? Can you repeat that balloon part?
Yeah, so
when you say the end of the term, for example, I've been telling sellers, hey, we'll do seller financing. It can be a term could be 10 years, and then they amortize it 10 years, 6%, whatever, but then I'll pay you out at the end of 5 years, at the end of 16 months. Can you give me 24 months of no payment or interest only? Is that 5-year balloon payment a no-no according to SBA?
So to answer directly is yes, it would be if the balloon was a mandatory payment. If it said that, Luther's got to make a lump, it's a 10-year amortization, but a balloon after year 5, for example, that would not be eligible to count towards equity injection. However, 2 things to consider on that. One, I'm looking at a deal now where it says there's no penalty if payment is made after month 48. That's a way to almost imply that it's your intention to make that payment, but you're not technically saying it is due. For that reason, we are comfortable with it as a bank. The other thing too is don't forget, we can do a note A, note B structure. So Luther, if you want, you can limit the seller note to be 2 years standby, no payments due, followed by 3 years principal and interest, no balloon for note A. That's going to count towards your equity injection. Then go to that seller and get them to hold more money on a note B structure. Now, because we've already satisfied the equity injection piece with note A, note B can be structured however you want, including having a balloon, having it due whenever. Just remember that we're going to utilize your projections to make sure that the business can realistically cash flow those payments when they come due, and we've got a realistic expectation to be able to satisfy the balloon, which of course I'm happy to give you feedback on. But to answer your question directly, Luther, if it says that there's a balloon, that's the no-fly zone. The gray area, which I will say on a recorded call, is that you want to set it up where there's an advantage to you to paying, but it is not mandatory. As long as you're not forced to pay at any point, it is technically not a balloon payment, and we will look at that to count towards equity injection. Source, I'm doing a deal with it right now, and David gave me his blessing. That's my chief credit officer, and a gentleman who is a fan of the acquirer, model, has had interaction with a couple AEs and certainly some folks in leadership, including Chris, Mooney, et cetera. So that's my answer on that one, Luther. And if you want me to,
sure, no. Thank you. No,
if you want to dig deeper, just hit me on the side. You got my cell phone number, man. Let me know if I can help you.
Let me jump in on that, Alan, if I can, to keep that discussion go a little bit further with it.
Yeah.
So we have situations come up from time to time where you might want to do that note A, so to speak, to cover that 5% of the equity and have that off the table. But then note B with the seller might have a forgivable component to it because of some unknown or yet to be determined aspects of, I'll give you the classic example. We had a deal where the customer concentration of the business was pretty dense with a half dozen customers, and 2/3 of the way through due diligence, the lead customer announced they were moving and going away. Well, that, significantly reduced the value of topside revenue, the amount of topside revenue and ultimate profits. But the seller also said, but I've got X, Y, and Z in the pipe that I'm working to close soon, and I expect success in being able to do that. While I originally hoped it would be a growth in the business, now it's going to offset that loss. We're still at the same level. And we kind of began a discussion about make that number, whatever it may be, a forgivable note. So in other words, you're still going to pay the agreed purchase price, but only if those 3 new customers make up the difference. How do you as a banker look at a forgivable note aspect in that mix of capital stack?
Yeah, I think it's a fantastic tool when appropriate. We certainly run into that. I'm running into a deal now. Nobody on this call, nobody in this program, so I can share a little transparently. You're never going to believe this, guys. The broker forgot to disclose that there's a 40% concentration risk. We didn't identify it until the customer list was provided during financial due diligence. Don't skip the quality of earnings. That's my pitch. I don't care that you got to do something. Anyway, in this example, we're probably going to walk. We felt that it was a misrepresentation of the sell side, and that's a character issue for ongoing trust. We're not comfortable with it. And there's plenty of other use cases, though, that are less extreme, where it's a great way to mitigate. As I've shared with some folks previously, I prefer to tie the seller note to something that is very easy to defend in the event of a dispute. Because when money gets involved, regardless of how much we love that seller and his great story or her story of how she built it from the ground up and, blood, sweat, and tears and all that, when it comes to money, who cares? There's no trust, right? So to protect us, I would like to tie it to top line revenue. Because if you tie it to other factors or metrics that, for example, net income, well, a dispute could be made of how you've tweaked or modified the expenses to perhaps manipulate or distort the repayment. Also, customer relations is a great one, Doug. More often than not, the reason we're doing these kind of structures is because of concentration or the perception that some new stuff is going. I always think that it's best to buy a business based on what it's done. Buying a business on what it's going to do is to pay the seller for your initiative and your hard work. It's simply not good business. The same I always say is when we look for egregious add backs as a justification of what true SDE is. I mean, if there's excessive travel, why are you going to pay 3.5 times on the seller's Disney World vacation with his wife and kids? Doesn't seem like a good deal for you, and it's definitely not a good deal for me. So we try to just kind of level set that way. But that's another example. Sometimes it's crazy add backs, and we can get comfortable with them with the quality of earnings report, where we have a third unbiased party saying, listen, this is really what it is, and we back this up using a general ledger or additional financials. Then the bank is willing to rely upon that with the additional proof.
Yeah.
That being said, sometimes we still want to make sure we're protecting ourselves, and a forgivable seller note is a great way to do that.
Right. Great word. Well, let's kind of stay at a higher flyover level here. Is there anything you're seeing, Alan, that has happened in the economy or even in the SBA guidance in the last, 6 months or so?
Yeah, well, I mean, I talked about this on a podcast that I do about SBA lending, and it was, hey, I'm excited. We're going to investigate wasteful spending in the government so we can make better use of our tax dollars. Then I get a text from my cousin in Pennsylvania. He said, hey, Elon Musk is going to shut down the SBA. So that was a not so exciting thing. And, strike one was the way the Cybertruck looks, but that's a personal opinion. Joking. I think they're very cool. But the fact is, I think that, the thing to remember in all of that is that the SBA 7A program is a little different than a lot of the noise that's out on social media and on the internet regarding, default rates and things like that. The SBA 7A program actually performs very well with a default rate total of just north of 3% for all loans made. Also, with the SBA guarantee fee, that is a way for the SBA 7A program to be self-sustaining. It is not relying upon taxpayer dollars. As it's independent and self-sustaining, I don't believe there'll be any significant changes. I did see there were some layoffs in the offices, but we've noticed no difference. As we're a preferred lending partner, we're not as reliant on the physical SBA unless there's a default event where we reach out to the SBA for them to come in with their guarantee to protect us against a total loss. Because we make all decisions in-house and we've got the delegated authority of the SBA, some layoffs in the general processing department didn't really concern us so much. I use jargon there, and I didn't mean to. So if you're newer to SBA lending, there's 2 different types of lenders, and this is very important. They can either be GP or general program lenders, which essentially are banks or even non-banking institutions that originate SBA loans. They underwrite them themselves, and then they send them off to the SBA itself in DC for final approval for funding. This creates a significant rift, as you might imagine. If you're a preferred lending partner of the SBA, you have what's called delegated authority. What that means is you don't need to have Big Brother check your homework at all. We can simply approve in-house and fund in-house, again, with the SBA only getting involved if the loan goes bad and the insurance policy that's on your loan needs to be called. The SBA 7A loan includes a 75% government guarantee. And I will address this because people ask, and they're well-meaning, but they say, well, Alan, the government's financing 75%. What do you guys really care? That's not what we do. We don't underwrite thinking about default. We don't underwrite planning for failure and liquidation. And quite frankly, the more deals that go bad and the more times you call in the SBA to make good on their insurance policy, the higher risk you're perceived, and you run the risk of actually losing that preferred lending status, which obviously is very important. So I hope I didn't get to the weeds too much on technicalities. SBA 7A is kind of all I know, unfortunately.
Yeah, no, I'm glad you went there, and I do think that's important, particularly for our newest AEs getting into this game and understanding. And I know we try to talk about that in our onboarding calls and some other things. There's a very significant distinction between that preferred lender and not preferred lender. As Alan indicated, the benefit of going to preferred is that you're going to get to talk to the team that's making the final decision. It's not some unknown bureaucrat somewhere that's making the decision. It's your direct banker there as long as they're preferred. So I do caution folks to really test that. When you raise your hand and you hit social media that you're shopping for financing for these deals, you're going to get flooded with brokers that are looking for opportunities, but they are just packaging deals. And even some of the other non-preferred banks, they're credible banks. You can find them, they're FDIC insured, they're everything, but they're not a designated preferred lender, and that means they're going to take your loan, but they're going to package it and send it up to an SBA office to get reviewed and underwritten. And the biggest issue there, besides complexity, is just time. It's going to take more time to get your deal approved, and you may run into the difficulty of not really getting to talk to the people that are raising questions and acting like they're declining your loan.
Mm-hmm. Yeah, that's a great point, Doug. And they call it a screen out. When you go general, it can make its way all the way to DC, and then they call it what's called a screen out, and then they come back and you have to kind of redo some things, and it can be frustrating. I worked with a bank previously that would go GP or general program if they were unsure of certain things. They were at that time cautious about certain uses of proceeds, specifically how it relates to subordination of certain other debt, etc. And the worst thing in the world would be having to go GP. Actually, that'd be the second worst thing. The first thing is getting a screen out. So you've already had to go GP, and then Washington, D.C. would come back with issues. So, just make sure there's that going on. And also make sure, in the spirit of fact checking, always make sure that, the bank that you're dealing with doesn't have a lot of overlay, right? Because SBA lending is challenging. It's the rule of two masters. There's the SBA SOP, or standard operating procedures. Think of that like the law. That's the Bible. That cannot be changed for any reason. And then there's bank policy or bank rules as well. And unfortunately, a lot of well-meaning folks in the market sometimes make the mistake of miscommunicating their bank policy as SBA rules. I've heard a lot of different scenarios where people say, well, my neighborhood, my community bank SBA person let me know that we need to put 15% down if we're going to X, Y, and Z. It's just simply not the case. So always get a second opinion if something doesn't feel right. And, try to rely on folks that do a lot of transactions, specifically for business acquisitions. It's highly specialized. No two deals are the same, but it's easy to pick apart speed bumps or potential roadblocks up front when it's all that you do. I used to have an uncle, well, he's still my uncle, but now he's older, but he used to always say, brain surgery is easy if you know if you know how to do it. And even though he owned a corner bar in nowhere, Pennsylvania, I think I knew what he was trying to say, right? So, make sure that folks are really dialed in on your use of proceeds, because someone who specializes in franchise startups is not going to be your best partner for a complex acquisition.
Yeah. And again, for the newest folks in our group here, the key word in what Alan said is overlays. So even when you're talking to a preferred SBA lender institution, ask the question, how deep and wide is their overlay? Because like Alan said, there is the base framework that is the SBA policy and procedure. That is the law of how the 7A program works per the SBA. But banks, depending on their own board and maybe even the regulators they're facing, and quite frankly, any of their history as a bank, what they've done and what the regulators have subsequently made them do different in their markets, they may create these overlay policies and expectations that might make it prohibitive, like an extra down payment of some sort over and above that 10% stipulated by the SBA. So it's a very healthy question to ask. And, I think about that. I know we certainly in my banking days, we were very forthcoming in our definition of overlays whenever we had any government program we were supporting. We actually had it in our collateral as a call out, here's the law, here's what extra we're going to ask you for. Now, we felt the client could go shop that appropriately. If they still liked us at the end of all that, then we might have had a good deal going on. So,
yeah, we have an overlay here as well that I think is important. So with my group at First Internet Bank, the SBA minimum debt service coverage ratio is 1.15 times. My bank's is 1.25 times, and that's the only bank overlay that we have. Additionally, find out when you're interviewing potential lending partners if they utilize a credit committee. And a credit committee is something that I used to have. And essentially, your business development officer, as well-meaning as they are, can get their deal vetted by credit. Everything looks good. And then eventually they go into, most often, literally a boardroom, or in this day and age, maybe a Zoom call or a Google Meets call like this one. And then they pitch the deal to 6 people. Generally, they are conventional commercial people, bank leadership, certainly some SBA folks. My last one had the head of retail banking for some reason. And then they're going to wax poetically about your loan request. I think one benefit to working with a group like mine that's highly motivated to get deals done is we just have David. Anyone that's talked to me about a deal likely has heard me say, well, let me just get with David and get back to you. We have a one-pen authority up to $5 million. So that's a benefit. I've got 2 Davids. Mark knows David Lee as well. He is my underwriter, and then David Bybee is the big boss. But essentially, I think that's beneficial, especially on deals sometimes when there's moving parts, to get the buy-in from the guy with the pen early on, and then find a way there and make sure that we're aligned to prevent going into committee and having your whole party ruined, which has happened to me admittedly at my last bank a couple times, which is why I no longer work here. It's one of the reasons.
Dana was chuckling, as was I. We have roots at the same institution that once upon a time had a very egregious committee process. And unlike many banks, our bank committee process was a 1 no vote rule. All it took was one guy at that table to do thumbs down and your deal was dead. And we had a large committee. It was like 20 people that would review deals. Now, these were bigger dollar deals. I think even at the 5 million level, I think it was probably, I think for us, it was maybe a 2-pen authority process. I don't know that we ever had a 1-pen only for much of anything, as I recall it. But, as a banker, you learn the process and you get very good at vetting deals and packaging them properly to get presented. And I think, again, I'm going to blow some more sunshine his way. I think that's what Alan has proven to be very good at. He will deal with our folks straight up early on to say, we're not going to be there. We're not going to be able to do that way. And give you that feedback, not to be mean-spirited, but just to be really honest about what they'll be able to do and provide some great intel on possibilities of other approaches. Mark, you have a hand up?
Yeah, I was just going to comment on the track you're talking on right now. The David Lee that I'm dealing with, I think that it's also making me think deeper about my deal. Like, I interviewed a bunch of banks before we're getting with First Internet, and I felt very transactional in those conversations. And I did feel the appropriate amount of thought partnership. They're not doing a deal for me, but they're definitely advocates for what I'm doing, pushing, poking and prodding in the right areas. But it's making the deal better. It's making me sharper in conversations with the broker and the seller. And I think they found a way to kind of, thread the needle of institutional, forbearance, but also partnership with those trying to buy businesses for the first time.
That's great. Max, you've got a hand up?
Yeah. Hello, everyone. Alan, I don't know if you remember me from the workshop.
We're talking about the high-end
Yeah,
wood business
yeah.
with connections easily transferable to the Dominican Republic. We have contacts there already, boots on the ground. In fact, we could get a 90% guarantee if we go international trade line. Have a good, Max.
Nice memory. Now I've got a nice memory from, I don't think you did this comment, but someone, I think was Rick or Rich, I remember that, and Hayden was talking about this too, that we only have to worry about the personal guarantee for 3 years, right? Because there was something that after 3 years, it was kind of a part was paid off. Do you remember that comment?
No, because unfortunately, one of the drawbacks, so the SBA 7A is awesome because it's a lot of leverage, that's why I love a 5-and-5 structure to maximize your cash on cash return when you continue to grow, whether it's holdco or you're chasing a big PE exit. But the unconditional government guarantee doesn't go away until you refi out of it. So there might have been commentary, Max, how the SBA 7A loans, when real estate's not involved, are 10-year term loans that have no repayment penalty. Secondary market data shows us that it would be abnormal for you to hold that note for the full 10 years, with most folks paying off between 4.5 and 6 years. That's the statistics that I'm provided with. I don't know why they don't put that together and call it 5.25 years. But it might be about that, Max, because once you have had the business under your own ownership, you've got 3 years of business tax returns under your ownership. You have strong performance under your ownership. At that point, you may certainly look to refinance into a conventional commercial loan, which would remove certain tenets, such as the personal guarantee. That may have been what was discussed, Max, but to be honest with you, as much as I wanted to impress you with remembering your deal, I don't remember the exact commentary. I apologize.
I think I'm gonna have to ask Hayden, but I have another question. I have a few questions about the collateral, because so the SBA might give you a loan for more than what your net worth is. So let's say your net worth is 1 million. Do they give you a $3 million loan?
Yes.
And then if you default on it, of course, you lose your million, right? You still have to pay whatever you have, right?
Oh, yeah. I mean, the SBA and the IRS are cousins. This debt will follow you until the government is paid back. Really, that's why I'm sometimes extra critical of deals, and I try to be objective as a value add to you, because the guarantee is no joke. What I like about this group specifically is what I saw in Fort Lauderdale. Actually, Max, specifically, like when you were pitching the deal and we went around the room and people shared insights, opinions, asking questions, that group think and that collaboration is really different than other groups that I've had exposure to, transparently. There's a lot of noise out there that it's super easy, right? You quit your W-2, 60 days later, you're rich. Like, nah, man, like there's too much that goes into this. All that is to say that there is no collateral requirement. The SBA SOP says very clearly that a loan cannot be denied based on a lack of collateral. Okay, so for that purpose, remember that we are looking at transferable experience. Have you had meaningful management of people, of budgets, of operations? What training do you have? What experiences do you have? What kind of maybe schooling? Have you been a manager in a meaningful capacity? We're looking for historic cash flow of the target business. Can the business demonstrate the ability to service the debt on an ongoing basis? And 3, your personal liquidity. That part can get a little confusing. We want to make sure that you have, after you make your equity injection or down payment, a minimum of 5% of the project post-close in cash or cash equivalents. Those are the only requirements. If you own no real estate, that's fine. I've made $5 million digital asset loans. Think about, online companies to folks that rent apartments. But what they had was good experience, a really good story, and most importantly, cash flow. Cash flow is king. So what you're describing is kind of what I was talking about earlier, that banks have different appetites. We don't care about collateral. I prefer not to deal with appraisals and all that if I can avoid it.
And the personal guarantee is for 100% of the amount of the loan.
Any partner 20% or more on the borrowing entity will have to provide an unconditional personal guarantee. The way the collateral rules are written in the SOP, I think it's page 174. And I only know that not because I'm a hotshot, but I had to source this for an email earlier today. Ultimately, it's that if you have 25% or more available equity in real estate collateral, it must be taken in a best effort to secure the loan. If you have less than 25% available equity in the real estate collateral, we will not take it. Some banks will still want to take it, and they have every right to do so, but it is not an SBA rule. That being said, we've talked about this, and if you're new to the call or the process or SBA lending, I might be getting in the weeds a little, and it's not my intention to overcomplicate or be confusing, but you have to pledge the collateral if there's 25% or more. If you have a HELOC, a home equity line of credit on the subject property that is undrawn, you haven't pulled a penny out of it, but it is in place to 80% LTV or loan to value, we will not take the collateral because we assume the HELOC's ability to be fully drawn would put us at a situation where there's only 20% available equity, obviously, with an 80% LTV play. So the way to kind of use the line of credit, it depends, right? It depends on what your strategy is. It depends on how important it is, and it depends on how committed you are to getting the deal done. I'd hate to see you borrow money just for the sake of borrowing money, but certainly it can present some complications when we talk about real estate collateral, which I'm hoping spurs some additional questions, as I field about 5 of those a day. Generally, people always want to know how it works and how they can avoid it. And that's a very direct answer. HELOC's a good way to shield it. There's very few other ways.
Sorry, go ahead. Go ahead, Max.
Sorry, just my last question. And so the business most likely has some assets. And so let's say the loan is $3 million, and then how does the bank value the assets? Do they value the assets?
I can let you know right now. It's very standard. So SBA has standard guidelines around that as it relates to fair market value. Commercial real estate, if it's in the deal, is credited at 85% of its fair market value is what it represents in regard to how much security it gives the bank.
Okay.
All equipment, okay? So imagine all heavy equipment, that's 50%. So you've got a machine worth $1 million, that's 500 grand worth of security it offers. And here's the real kicker: AR, receivables, etc., 10%. It's almost worthless to the SBA. We really don't care about that.
Okay.
So that's how we would look to qualify the assets of the subject business. The lien on any residential real estate or commercial real estate you own, etc. If it is 25% or more available equity, the lien would be limited to the amount of the loan less the assets in the business using the discount rates we just discussed. So, if you've got a business, the loan's $1 million, the equipment's worth $1 million, the lien on the collateral on your residential will be $500,000 because equipment has a 50% security rate. They call it a standard discount rate in the SBA land. Hope that's helpful.
Yes, thank you.
And let me go back to the original part of that, Max. The question about the reference to a 3-year release of the personal guarantee. I can tell you, we have this discussion frequently, and I actually think it comes up at just about every workshop. What you likely heard, because I think it's consistent with Hayden and Rich, is that by the 3-year mark, to Alan's point, you are probably ready with the history of the business and your own recognized, realized profits from the business. You can go refinance the SBA. And when you,
that was it.
the
That's
banking
what-
term is extinguish the note. When you extinguish the note with the SBA, the guarantee goes away.
I've seen people do it after 2 years, Doug, in my personal experience. Never before 2 years have I seen it though. But generally 2 years, it's possible. 3 years, it's probable, as long as the business is performing well and we can rely upon the new ownership.
And again, without trying to get too deep into the weeds, but you also get into the impact of doing a stock purchase versus an asset purchase. If you do asset purchase, your business history clock starts over on day one.
Yep.
So you might need that 3-year history to build enough background for a commercial lender to entertain the deal. 2 years might be stretching it, but if you did a stock purchase, you can pull forward that last year from the prior owner as part of the history on the performance of the business to justify a new line of credit. So gets a little more complicated there, but in spirit of that discussion, how do you get rid of the SBA guarantee? It's usually what we talk about anyway is about that 3-year horizon. You will have sufficient performance documented and a higher probability of opportunity to go refinance in a conventional commercial loan.
That's a great point. Yep. And that's what I would do. And I'm the SBA guy. Honestly. Luther, we got our hand up.
Yes, sir. So with that line of credit, like a HELOC, right? Just to kind of continue down that path, like I know the SBA or the lender in your case would also want to see, my understanding is that you want to see at least 6 months of payments that you have. Like, so basically, like, let's say it's like, I don't know, $30,000 a month, right? So you want to see at least $180,000 worth of liquid assets in the borrower's account. And could the HELOC like meet that requirement? Does that make sense?
It does make sense, but I do want to make sure that I clear up some misconceptions that I think that you have. So what we want to see post-closing is 5% of the total project cash or cash equivalent on hand. That is more reasonably 3 months of payments in my experience, not necessarily 6. That being said, we're going to count cash or cash equivalents. What does that mean, right? It means very specifically checking, savings, retirement accounts, even 401ks. We're going to count as cash equivalent because in the case of an emergency, you can access those funds. Sure, you might pay a penalty. Sure, it might take 3 days to clear if it's in the stock market, but you have access to that cash. So I don't want you to liquidate those accounts. You can leave them as they are, but we do find comfort in knowing that they're there in case of emergency. Now, let's say you're falling short of that amount. If we look at everything that you have on hand and you are short, but you do have a home equity line of credit, yes, we will include that when we consider your total post-close liquidity. However, I'll be really honest with you. If you are putting everything into the deal and your only post-close liquidity is a HELOC, let's manage our expectations, and maybe we don't need to eat an elephant right away, and we can start a little bit smaller. You know, I've dealt with some acquisition entrepreneurs that have shown great success by, starting with maybe a smaller business, because don't forget, through SBA's expansion financing, you can do your second deal with 0 down. So if you buy a business and 12 months later, you want to buy a competitor, as long as it's in the same industry and the same reasonable geography, which is up to interpretation now, you can actually make that purchase with no money down. So that can assist you on a roll-up strategy or a tuck-in strategy. We're talking about the same thing, probably using different terms. But yeah, Luther, the HELOC is certainly helpful, but I wouldn't rely exclusively upon it. I'd like to see some cash or some savings or some investments or some retirement. I want to see something you can turn into cash without having to pay it back with interest.
Makes sense. Thank you.
Yeah.
Hey, Alan, can you hear me okay?
Hey, Dan, how are you?
Hey, appreciate the time today. This has been super helpful. I was wondering, I've gotten asked a couple times if I'm pre-approved for an SBA loan. Is that a pretty simple process to get pre-approved? A couple lenders that I've talked to have had only pre-approved for really small amounts, like less than $500,000. And others have kind of scratched their head at that notion, not knowing what business buying.
Yeah, so to get a pre-approval, all that we're going to want to see is a management summary or resume that can be in any format that you might have available, just explaining, hey, this is what I've done, and when I was in that role, this is kind of what I was responsible for, and then your personal financial statement. With that, I always pre-approve at the max dollars that I can, with the assumption of a 5% down and a 5% post-close. So to use really easy math, if you've got $100,000 to your name, I'll pre-approve you for $1 million.
Okay.
One thing you'll notice, though, a lot of banks will not honor retirement or 401ks when doing that, and they really want to see checking or saving statements. That's not the way we look at it. And, if you'd like to see a second opinion, it goes without saying, I'd be, eager to see it if I can show you some more value in that regard, if appropriate. Listen to the team around you. But if they say, hey, go get that pre-approval, I'm always happy to jump in and manage those expectations. So we're looking at the right size businesses that'll really get approved.
Cool. Thanks. One other question I had, you mentioned quality of earnings and client having 40% customer concentration.
Having flashbacks, Dan. It's too soon. It still stings, man. But yes.
Is that one? So when you say customer concentration, is that like top 5 customers, or one customer was 40%? And then in addition to that, is there an indicator that you look for in who produced that quality of earnings reports that tells you as a lender, like, I can have confidence this is a quality kind of audit and statement?
Yeah, so we like to see an unbiased third-party performance. Many AEs that have come through the Acquire model have produced quality of earnings reports that I've found to be very, very good, exactly what the bank wants to see, and certainly adequate. So, reach out to your team internally. That's what we're looking for. I want to see a third party really audit those, not, us or anyone that might have a horse in the race, because entrepreneurship optimism can sometimes cloud our better judgment, and I'm guilty of it as well sometimes. If I like the AE, I like the deal, but the deal doesn't really pencil, but I'm trying to push. And what that turns into is a really stressful situation for everyone that could have been avoided. I know that search can take a long time. People can feel deal fatigue in every stage, but I would rather you wait 13 months and do the right deal than close the wrong deal on month 12. Financial due diligence just further supports our position that we are doing the right deal. And I hope that answers the question for you.
And I want to jump in on that, on the quality of earnings, again, for the benefit of our newest folks that are joining us, because you're learning a lot of these terminologies and requirements and things. There is a big difference between a proof of deposits and a bona fide quality of earnings report. And then when you go to the market or start Googling, you're going to find vendors that will give you a verification of deposits, but that's nothing more than a third party trying to do a simple reconcilement of the company's records versus what the bank statements say. That is part of a quality of earnings report, but the quality of earnings goes a lot further with looking at things like classification of entries. And is that consistent? Are you getting the correct math to get you down to net income? And is all of that being accounted for consistently and properly? Our vendors that we recommend for quality of earnings will also help you build a case for the amount of working capital you need in that business. One in particular actually uses GAAP accounting and gives you 3 different versions of how working capital is commonly calculated, and then proposes a melding of those three to give you a number that you ought to rely on. So that kind of insight and advice is invaluable. And when you go to some of the podcasts about deals gone wrong, you're going to hear 9 times out of 10, you're going to hear the fact that the buyer did not execute a quality of earnings during the due diligence. They just took numbers at face value. They plowed through it. They got comfortable with the broker and seller, and sadly were sold a story.
Yeah, thanks.
Thank you. That's very much a buyer beware kind of message there.
Doug, just to piggyback that, if I may, that's a really big deal for us too, because the bank, like, we'll calculate the working capital need using a projected balance sheet. So if I have, like, historically the business holds X amount and this is their AR, this is their collection cycle, this is their, all the expenses, if they're 90-day AR, I want to try to find a way to overfund you any way I can, and then we have the ability to add a line of credit. Make sure whomever you're dealing with can offer you a line of credit. That's something, and if you don't need it, you've got personal liquidity that, and push comes to shove, you're okay, then that's cheaper money, okay? That's different. But if you are relying upon the bank to support the working capital interest, the quality of earnings is great because they do such a deep dive that it really just tells the bank, like, hey, I need $250,000 just to make sure I'm around in 3 months while this catches up. And by the way, we see this. And then we can also use that for your future growth initiatives. The line of credit is great. Like, if you don't want to hire, if you're not going to hire people day one, why would you take it? Why would you take working capital day one that you're going to be paying interest on effectively when you're really not ready to use it? So just keep that in mind. And to answer your question before, I'll make it really quick. You're like, was it one customer? Yeah, it was. How do we not catch it right away? It was six different ordering purchasing managers from one very large organization. And then when they finally realized, like, hey, these are 5 order sources. Oh, wait, they all work for the same company. That's where that came up. So I'm sorry, I forgot, but you did ask that earlier. So in case you're curious, that's what happened last night at 10 p.m. Just put my kids, my kids have been asleep for a couple hours, but I'm just typing away. I'm like, no. Anyway, but we dodged the bullet. We dodged the bullet. You know what's worse than that bad news? What's worse than that bad news is my client signing an unconditional personal guarantee on a deal where if a key customer walks, they're filing bankruptcy. That is way worse than getting bad news. I promise you that.
Yeah.
Thank you.
Good point. Very good point. All right. I know we're about up on time. Aaron, you had a hand up, I believe.
Yeah, I just have one quick question. Thank you. Alan, nice to talk to you again. Real quick, for real estate collateral that's considered against the SBA, if you have it's technically owner occupied loan, but it's in the process of being owner financed under a contract for deed. Is there a way of shielding that because you have another contract with a third party saying they're in the process of acquiring that real estate? So you have a promissory note, but technically I still hold the title on it. I'm just curious if there's a structure or a way to protect that so that those buyers aren't at risk in any involvement in any kind of acquisition.
Yeah, that's a good question, Aaron. And my answer would be that, having something in process, having a promissory note in process is certainly worth sharing. But if the existing note, so under the example that you've used, without getting too into the weeds at the end of this call, I'd be happy to dig deeper with you offline. But here's my quick answer. If you currently are in a situation where the current note would not be adequate to protect the property, in other words, you're going to a private note and the private note is going to be at 80% LTV, the current note is at 70%, which would mean we have to take the lien. If that's the scenario you're describing, I would wait until the private money note, so to speak, is active, live, filed, recorded, okay, before moving forward. If it's something where it's both the same apples to apples with an LTV situation and there's collateral or not isn't hanging in the balance, it really doesn't matter. And as long as the deed is recorded correctly, and we'll find it when we're doing, our UCC and lien searches on the target property and everything's filed the right way, then there's really no issue. But if it's a scenario where the new loan is going to hit the LTV high enough where that it will not have to be taken as collateral, my advice would be to please get that in place before we fund. We can make note of it, but at the time of actual funding, it should be in place. That way we're compliant with the SBA, and we would continue to process your loan and simply hold off until our searches reflected that we did not need the collateral. And at that time, we would fund the loan and you'd be in good shape. And if I misunderstood or that's not helpful, Aaron, please feel free to reach out to me offline. And I'd be happy to walk through this with you in more detail.
Yeah, I just want to hear the high level, so we can talk more when it becomes more pertinent. Thanks.
Yeah, I like a curveball like that, dude. That's usually it's people like, what do I do? And I don't have a license. And I want to buy an HVAC company. Those are easy.
Yeah.
Aaron's getting the weeds. I like it because we don't want to take collateral. Full disclosure. We prefer not to if we don't have to.
Yep. Yep. A lot of backside processing costs if you have to ultimately take that collateral. So really appreciate that. All right. Well, in respect of time, we're about up on the end. Any final thoughts or questions from anybody that we can hit real quick? Nope. Well, Alan, thank you much, my friend. I'm sorry I missed you on the last Florida trip, but I'll see you in April, I'm sure. So looking forward to that. And for now, I'm going to say goodbye, and we'll see everybody again next Monday. Have a good one.